Hi everyone, today we'll explore the differences between buying options and selling options. For context, there are only two types of options contracts, calls and puts. So all our activities in this domain revolve around these two contracts. Now, up to this point in our course, we've mainly discussed buying options and haven't really looked into selling. While we've touched upon the role of the option seller, we've often portrayed them as this unseen entity on the opposite side of the trade. We haven't discussed how one can build a core position by selling options as opposed to buying options, and how this can serve as a foundation for trading for income. Something that we focus on here at the income option. So let's look at this table. This table highlights the rights and obligations that are associated with buying or selling calls and puts. Now keep in mind, every trade has two players, a buyer and a seller. And in the world of options, you can only ever deal with calls or puts. So we have four basic options actions: buying a call, buying puts, selling calls, and selling puts. So when you buy a call, you acquire the right to purchase the stock at a predetermined price in the future. As an options buyer, you pay a premium. Essentially, you are investing in the privilege of making a choice later on. So as an option buyer, you secure the right to buy the stock at a set price in the future. For instance, an option buyer might purchase a call option on a stock with a 50 rupee strike price, indicating that they want to buy that stock for 50 rupees per share anytime between now and the option expiration date. Conversely, a put option buyer has the right to sell the stock at a predetermined price sometime in the future. So even though they pay a premium to the option seller, just like a call option buyer for a buyer of a put, for them, the intention shifts. So instead of aiming to buy a stock, they want a guaranteed sale price for the stock in the future. They might wish to sell the stock, for example, for 50, hoping that its market value drops to 30. In that case, they could purchase the stock in the open market for 30 and then resell it at their guaranteed price of 50 rupees. Now, the fundamental point for options buyers is that they pay a premium, and in return, they receive this right or choice from the option seller. Now let's switch perspectives. Let's look at the option seller. Option sellers undertake an obligation because they transfer their rights to the option buyer. They must sell the stock at a specific price in the future, but this obligation arises only at expiration, and so it's crucial to understand that this doesn't mean they are bound indefinitely. Option sellers can exit the contract by selling it or buying back their obligations. But the essence of being an option seller is that you have certain obligations. For instance, if you commit to an option buyer that you'll sell a stock for 50, and if that contract goes till expiration, you must honor that price. Similarly, on the put side, as an option seller, you are obligated to buy the stock from the option buyer at a predetermined price. So, if a put option buyer decides to sell you a stock for 50, you are obligated to purchase it at that price. Your hope as the option seller is that the stock's market value is higher, allowing you to profit from the difference. Remember, the option seller receives the premium from the buyer. The rights are thus transferred from the seller to the buyer. And this cycle, this exchange, holds true for both calls and puts. Now, we've recreated this graphic from inspirations from the net, and this helps us explain the dynamics of options trading. This four-part diagram helps set expectations about stock behavior in various scenarios. For instance, if you are a call buyer, you're anticipating a rise in the stock price. This means you purchase the call options expecting the stock to increase in value. On the other hand, if you're a put option buyer, you're hoping for a decrease in the stock price, specifically below the strike price that you have chosen. Now, if you're selling either a call option or a put option, remember you're receiving a premium. The responsibility, or rather the risk of the stock moving and impacting this premium, primarily lies with the option buyer. By accepting the premium, you are foregoing certain rights, allowing for the stock to remain stationary, thus potentially profiting, even if the stock remains range-bound. So, even if the price stays where it is or moves down, you still make a profit. So, as a call option seller, you desire the stock price to decline, while as a put option seller, you wish for it to either rise or remain where it is. So, as a seller, you're happy if it stays where it is, but as a call option seller, you would rather have it come down. And as a put option seller, you'd rather have it go up. Now, we look at various examples, but this graphic, this diagram serves as a handy reference. You can even think of printing it and keeping it on your desk to help you understand options trading deeper and take it forward from there. So, let's now look at the differences between credits and debits and the process of opening and closing trades in options. Now, whether you're trading calls or put options, the principle remains the same. The distinction is between going long, which is buying to enter, or shorting, which is selling to enter. So, take for instance, if you're buying or going long, you start by buying to enter or buying to open. So, on some platforms, this is indicated as BTO. Now, when you buy to open, you are paying out or debiting to your trading account and paying that money to the option seller. However, you can choose to exit your position before expiration, and so to do that, you would enter a sell to close order, and obviously you would hope to receive more money than you initially debited to your trading account. So, let's say you paid 5 rupees here, you'd hope for it to be sold at 7 rupees, netting a 2 rupee profit. Conversely, if you're selling options, that is, you're going short, you initiate with a sell to enter or a sell to open, right? Now remember, as against buying to open, you're now selling to open. You're not selling to close, but you're selling to open. And so here you receive a credit when you open. Now it's important to note here that as against a debit in the case of going long, when you're shorting, you're selling to enter. So here you receive a credit. So as you remember, there was a debit when you entered a long position and a credit when you exited it. Now, when you are shorting, you are actually receiving a credit because you're selling or writing the options contract. So, if you decide to close out as a seller, you would buy to close or BTC. Now, the goal here, of course, is to spend less than you initially received. So, using our previous example, if you got credited 5 rupees initially, then you would hope to spend only 3 rupees to buy it back to buy to close, right? Resulting in that 2 rupee profit again. So, remember, credits add to your account while debits subtract. Now, for clarity, imagine you're an option buyer. To acquire this contract, you pay, and so your account gets debited, while the option seller is paid, and whose account in turn gets credited that amount, or who in turn gets that money. So, you pay the option seller, and if you wish to exit, you would sell your contract, hopefully for a credit, right? So, in that situation, you will sell it to the market and you will hopefully get more money than you paid for it. The new buyer would then debit their account and we will complete this cycle. I'm sure you found this video helpful. If you have any questions, concerns, comments, or any kind of observation, please do share them with us in the comments section.